Silver has just experienced one of the most dramatic crashes in modern precious metals history. In just 3 weeks, we've watched silver plummet from an all-time high of over $121 per ounce in late January 2026 to around $75. Today, February 17th, that's a staggering 40% collapse in less than a month. If you're holding silver mining stocks right now, you're probably feeling the pain. But here's the thing about market crashes. They create opportunities. And today we're going to dive deep into 5 silver mining stocks that deserve your attention after this massive sell-off. Before we get into the specific companies, let's talk about what just happened in the silver market, because understanding the crash is crucial to understanding the opportunity. Silver's incredible rally to $121 wasn't just hype. It was driven by real fundamentals. The silver market has been running a supply deficit for 5 consecutive years. And 2026 marks the 6th year in a row where demand exceeds supply by approximately 67 million ounces. That's a significant shortfall in a market where annual mine production is around 820 million ounces. What really turbocharged silver's rally in late 2025 and early 2026 was a liquidity squeeze in the London physical market. You see, there were concerns about potential tariffs on silver imports into the United States under Section 232 critical minerals investigations. Smart traders started moving massive amounts of physical silver from London to New York to hedge against potential price spreads if tariffs were imposed. This left the London market, which is the global physical hub for silver trading, extremely tight on inventory. When you combine structural supply deficits with a physical liquidity squeeze and strong investment demand, you get explosive price action. Silver shot from the low 80s in early January to break through $100 for the first time ever, eventually peaking above $120. But then reality hit. The Section 232 report came out in January and didn't impose tariffs on silver. That removed one major catalyst. More importantly, we saw what JP Morgan analysts describe as speculative froth. Retail investors, particularly in India and China, piled into silver with both hands during the rally. Investment demand surged, but global silver ETF holdings actually started declining even as prices climbed higher. That's a classic warning sign of an overheated market disconnected from institutional money. The final straw came with Federal Reserve policy uncertainty. Markets had been pricing in aggressive rate cuts starting early this year, but stronger than expected jobs data in January changed that narrative. The U.S. added 130,000 jobs, more than double expectations, and unemployment unexpectedly fell to 4.3%. This pushed rate cut expectations out to June at the earliest, according to the CME FedWatch tool. Remember, silver is a non-yielding asset. When interest rate cuts get delayed, money flows out of precious metals and into yield-bearing investments. Today's 4.5% crash to $75 was amplified by thin market conditions. Asian markets are closed for Lunar New Year holidays, and U.S. markets were just closed Monday for President's Day. Low liquidity means bigger price swings. Add in a strengthening U.S. dollar, which rose 0.3% to 97.08 on the dollar index, and you've got the perfect storm for precious metals. A stronger dollar makes silver more expensive for foreign buyers, reducing demand. So where does this leave silver mining stocks? Here's what's fascinating. While silver crashed 40% from its peak, many quality silver miners haven't fallen nearly as much. Why? Because professional investors understand something crucial. These companies are now generating absolutely massive cash flows at $75 silver. Think about it. Most silver miners built their business models assuming silver prices between $20 and $30 per ounce. Even after this crash, silver is still up 128% year over year. And trading at prices these companies could only dream about 2 years ago. Let's talk about the 5 silver stocks you need to watch right now. First up is Pan American Silver Corporation. This is one of the largest primary silver producers in the world. And right now, it has an investment rating of hold with a target price of $62. What makes Pan American interesting is its geographic diversification. The company operates mines in Mexico, Peru, Bolivia, Argentina, and Canada. Mexico and Peru are 2 of the world's top 3 silver-producing countries, so Pan American is positioned right at the heart of global supply. The company's portfolio includes the La Colorada mine in Mexico, which is one of the highest-grade silver mines in the world. At current silver prices around $75, Pan American's profit margins are exceptional. Here's the key insight. Even if silver drops to $60 or $65, this company remains highly profitable. The crash has created a potential entry point for investors who missed the rally. According to the latest forecasts, silver mine production globally is expected to increase only 1% in 2026 to 820 million ounces. That's barely any growth. Meanwhile, Physical investment demand is forecast to jump 20% to 227 million ounces. Pan American is well positioned to benefit from this tight supply-demand dynamic. The second stock to watch is a Hecla Mining company. Hecla is actually the largest primary silver producer in the United States, and it's been in business for over 130 years. This company has survived every boom and bust cycle in precious metals history. What caught my attention about Hecla is its Keno Hill project in Canada, which is ramping up production right now. According to supply forecasts for 2026, Hecla's Keno Hill is specifically mentioned as one of the operations driving higher output in Canada this year. Hecla also produces gold, lead, and zinc as byproducts, which provides some revenue diversification. But make no mistake, this is a silver-focused company with about 50% of revenues coming from silver. At $75 silver prices, Hecla is printing money. The company's all-in sustaining costs are well below current silver prices, meaning every ounce they produce generates significant free cash flow. The big question for Hecla investors is whether management will use this windfall to pay down debt, increase dividends, or acquire new assets. Smart capital allocation during this period of elevated prices could set Hecla up for long-term success. Third on the list is Coeur Mining, and this one's particularly interesting right now because they're in the process of acquiring New Gold's New Afton operation. New Afton is specifically mentioned in supply forecasts as one of the Canadian projects expected to boost silver production in 2026. Coeur operates multiple mines across North America, including the Palmarejo silver-gold mine in Mexico. What I like about Coeur is their operational flexibility. They've shown they can adjust production levels based on metal prices, which is crucial during volatile markets like we're experiencing now. The New Afton acquisition is strategic because it adds both gold and copper production, further diversifying Coeur's revenue base. In volatile silver markets, having multiple metal exposures can smooth out earnings. At current valuations after the sector sell-off, Coeur is trading at attractive multiples relative to its cash flow generation at $75 silver. If silver stabilizes anywhere above $70 for the rest of 2026, Coeur should deliver strong financial performance. The fourth company to watch is First Majestic Silver. This is a pure-play primary silver producer with all of its operations in Mexico, the world's largest silver-producing country. According to the latest supply analysis, Mexico is expected to see the most growth in primary silver mine production during 2026. First Majestic owns and operates multiple mines including San Dimas, Santa Elena, and Jarrett Canyon. The company has a unique business model where they sell a portion of their silver production directly to retail customers through their bullion store, capturing higher margins than selling to refiners. Here's what makes First Majestic compelling after the crash. The company was already profitable at $30 silver. At $75, even after the crash, they're operating with enormous profit margins. The risk with First Majestic is concentration. All their mines are in Mexico, so any country-specific issues like regulatory changes, labor disputes, or security concerns could impact the entire company. However, if you believe silver will remain elevated or recover toward the $80 to $90 range that J.P. Morgan forecasts for 2026, First Majestic offers leveraged exposure to that price move. The fifth stock is MAG Silver, which takes a different approach. MAG is a development and exploration company with a significant stake in the Juanicipio project in Mexico, operated in partnership with Fresnillo. Juanicipio is one of the highest-grade silver projects in the world and is currently in the ramp-up phase. What makes MAG interesting is that it's less about current production and more about future potential. The company is essentially a call option on higher silver prices with exceptional asset quality.